Welcome to the VestCapital podcast, the go-to platform for accredited investors, real estate developers, and entrepreneurs seeking to build wealth by investing in private real estate.
Are you not entertained? Are you not entertained?
Every time, every night is a loose one. And every flight, you know that I put the crew on. You say that I drop.
Welcome back to the VestCapital Private Equity Podcast. My name is Tanner Wideriksen, your host. As always, it is amazing to be here together with you. This is an incredible opportunity that we have to discuss the private equity component and to dive a bit more on a granular level in connection to the capital stack. So just recently, VestCapital had the opportunity to take down a large size asset here in our local community. We're incredibly excited about the opportunity for our investors to participate side by side with us and to create something really compelling for the community and our shareholders alike. So I wanted to analyze a bit more how we brought in the preferred equity, how we brought in the senior debt, and the different layers that comprised of the capital stack. Because the success is dictated by how the capital stack is structured and the risk profile to the developer and the investor. So if you're an investor looking to invest in commercial real estate as a limited partner in a passive position, it's incredibly prudent that you underwrite how the sponsor is structured in the capital stack. So for those reasons, I'm taking a deeper dive into how we structured this particular deal. So starting from the top, we were able to tie up this piece of property, which consisted of 3 independent buildings. It was multifamily. These 3 buildings were on 3 fee simple lots, okay? And in our feasibility, we determined that there was historical legal lots that were created at the original recording of the plat. And over the decades, they were combined to only 3. But in reality, upon the origination of this particular plat, there was 6. So we were able to identify 3 additional legal lots of record during the feasibility. We went through the appropriate channels to have the county reconfirm and display on the county records the true existence of this plat. So bonus to our firm, we were able to proactively unlock value on this infill development. It's incredibly important that your sponsor is not passive on any levels of the game of real estate, but always taking an active position. That was step 1. When we identified these additional lots, we were able to identify the business plan. So in our situation specifically, we wanted to rehab these existing buildings and increase the net operating income, add additional dwellings, and be in a position where we have the surplus land free and clear to then develop additional assets on down the road. And we would go through likely a site plan process where it would be all of 12 months between design, engineering, and permitting. Going back to the capital stack on the acquisition. So the appraisal is what drives the overall value of what the financial institution will provide you in the form of leverage, debt financing. So just an example, if the asset is valued from an appraisal position, a formal appraisal at, say, $10 million, then traditionally these financial institutions will extend on a project like this up to, let's say, 70% loan to value, LTV. So they will extend $7 million of the $10 mil for in consideration of this loan package. The sponsor, the developer, is then required to bring in the remaining $3 million in preferred equity. So this one had a different layer of it because we were going to be adding additional dwellings, increasing the net operating income, therefore increasing the future value of these assets. So in order to get from the current valuation where we're at right now to a future valuation, we had to lift up our sleeves and to perform a tremendous amount of construction on these projects right here. So we were able to secure what we call a construction holdback loan. The construction holdback loan is a dollar amount that is tied to a project scope that derives to the valuation of the after repair value of the project. So the lender will hold into reserves a construction budget that is only extended to the borrower upon successful completion of the improvements. They want to protect themselves, and they do not want to extend the funds out on day one when no work has been completed. So the process, how this works with this particular project that VestCap has under development and construction, is we perform the work, we pick up the tab on the work, and then we then submit our draw request to the bank on a monthly basis, and then the bank then inspects the work performed and then reimburses us for the work that was conducted. And our loan balance is accruing interest on the extended funds that are drawn upon. So for example, if there's $1 million additional dollars held back for construction and rehab, the lender is receiving their interest as the draws are extended to the borrower. So we can look at that as a line of credit, a form of an LOC where you are only paying interest on the drawn funds. So there's a balance between taking on too much leverage and putting the project at risk, where the project, when it's fully stabilized, might not be able to accommodate all of the servicing of debt. So a good rule of thumb that we utilize is a DSCR ratio of 1.25. So if the property is generating, for example, at 100% debt service coverage ratio, we want 25% surplus of cash reserves for expenditures and for operating expenses to ensure that we have the performance on that asset to service debt. So backing into this particular deal that we recently acquired, we were able to bring in a senior debt loan, and then we backfilled that with preferred equity, and then we also had that construction holdback component, and that is extended to us as we complete the construction. So this is a particular project that's going to be enduring about 12 months, and then there's going to be a liquidity event in the form of either a sale or refinance, where our investors will then receive their initial principal investment back, plus a pro rata percentage share of the profits. And this particular deal has the surplus land on it, so we will be in design and engineering over the next several months to then create another asset with a much lower basis walking into that project. So it's incredibly critical that there's an alignment of interest between the investor and the developer, where the usage of leverage is moderate, where we're not overextending, and we have confidence that in the event the market does pull back and dip down, we can then satisfy and perform on that asset and then preserve our investors' wealth. Appreciate you guys for coming along for this ride on this segment for the private equity component of the VestCapital podcast. We will see you in the next one.
That's what I'm constantly summoning. I love the climb, I don't care where the summit is. Funny when people be saying I peaked. Retired, my parents, they live at the beach. Models and freaks is my track record. I make my homies my staff members. Got myself lit to give y'all the light. Using my mind to attract better.